Homework 6 was originally due a week from today, but since this weekend is Easter Sunday, and a lot of you guys will probably be not here and available for that, Homework 6 is going to be an in-class assignment next week. So after you finish the midterm on Wednesday, enjoy your another long weekend. Don't think about the class until Wednesday when we come back to class. So we'll do Homework 6 in class next week. Okay? Yes?
So there's no class Monday?
No, there will be a class a week from today.
Okay.
But what I'm saying is Homework 6 was due next Monday, and the midterm's Wednesday, and Easter Sunday, and the whatever bunch of religious holidays are coming up this week. So basically, yeah, is that this week as well?
Yes.
Yes. So a lot of religious holidays this week. We got Easter, we got Passover, others. So basically, instead of having Homework 6 and the midterm, we'll just push Homework 6 until next week. Okay? All right. So let's talk about the as-is for delta. So basically, as you put data in, WAC was 9.5% earlier today. Depending on your share price, mid-54 range for the current share price. Put in the shares outstanding. This was the EEO data for sales and EBITDA. This was the trading multiple this morning. Your number might be slightly different depending on what time of day you did it. For EV to sales, EV to EBIT, giving you this EBIT margin. So basically, over here, tax rate, first 2 years, 15%, then going to 24%. This came from the Investor Day presentation where they said that the NOLs that occurred previously would be extended through 2019. So basically a 12 to 15% tax rate, and then it jumps in to 22 to 24 thereafter. So I basically, using the Investor Day guidance from Delta, put 2 years of 15%, and then I made it 24 thereafter.
Would it be okay to average it out for the first two, or fit between 12 and 15?
You could,
Okay.
but I'm just saying that the point I wanted to just make is that here's an example where in the past we kind of had like one rate for the future.
Right.
With Delta, they actually said for the next couple of years it's going to be lower, then it'll go higher.
Right.
But it's not going to go back up to 35, 36 because the U.S. tax rate is now 21. So they basically say U.S. plus state and local 21 plus. So they said 22 to 24. I was at the higher end of the range. You could be at the lower end of the range. They did give a range. Okay, but the point is you'd have two ranges for tax rates. The other thing is from here, we want this approximate EBIT margin, operating margin, to be this number in the out years, which backs into a 20.3% EBITDA margin. Now, based on the consensus estimate, they get to 22 by 2020. So basically, it doesn't really change that much over those 4 years. Okay, and then once we put that data in, get these growth rates based on the EEO, we would have tried to estimate our G. And herein lies the challenge. So, in order to match the G's, we'd probably have to get a G of something like, if I put in, if I had just the 3% played out, then what I'm going to need is a G of like negative 10% or even worse, negative 12% to get closer to the current share price. And to be honest with you, that just doesn't make sense. Okay? Because basically what it says is Delta's going to have a really bad time in the future. And if I look at the analysts, that's not what the EEO suggests. They have 19 buys and 0 holds or sells. And even in the Investor Day presentation, they talk about all the growth, competitive advantage, and good times ahead. So this is what I'm saying, is that to mathematically solve the formula to get a G of negative 12 just doesn't make logical sense for Delta Airlines. Okay, so here is where we have to, again, recognize that this is the exception that proves the rule. All right, so the rule is the academic data, the academic formulas have to match the forecast data. That's what we're trying to do. But here, to match the forecast data using the academic formulas, we're getting crazy information. So we have to try and understand why. What's breaking down here in the academic formula in the as-is. So I want to take a divergence and I want to go to the homework because I think that's going to give us some insight. So let's look at Delta's ROIC tree from the homework. So as we walk through the ROIC tree, and I'll make it a little bit bigger, first of all, we see that 2013 was an outlier because of the crazy tax rate. And if you go back to the 10Ks, what Delta basically said is that the accountants reclassified their deferred taxes, how they were handling them, which basically gave them a big refund, but B, an accounting loss, okay, which basically rippled through their taxes for the next several years. So part of Delta's weird numbers go back to an accounting reclassification for tax purposes of how they were handling their deferred taxes. So long story short, 2013, this is an outlier. These are more representative years. So it's almost like I would say 2014 end of year ROIC was 5%. It grew to 12.4% over that 4-year period because 13 was an outlier. Tax rate went from 38.5 to 37.3 over this 4-year period. 2013 was an outlier. If I look at the pre-tax, 2013 started 11.2, fell to 8.1, but over the 4-year period, it went from 8.1 to 19.8, but it bowed, meaning the big jump was between 14 and 15 when it went from 8.1 to 27.7, and then it's been declining the last couple of years. Now, what was behind that is all operating margin. Operating margin went from 5.5% in 2014 to 19% in 2015, and then settled at 14.8 in 2017. Okay, productivity went from 67.7%. It worsened to 74.9 over the 4 years. So it was really the decline in the operating margin. Now, when we get to our second level analysis, this is where accountants again muck us up, because gross margin is 105.4%. How can that be 105.4%? Well, if we go to Delta, and if we look at the other revenue, which is being added to revenue, and we look at what they call other revenue for transparency, this is the report that Bloomberg used to basically get their other revenue. And if I search for other revenue, I see what makes up the $5 billion. Basically, almost $2 billion is going to be loyalty programs. A lot of that comes from the Delta American Express credit card. So they're basically paid by the credit card company, American Express, for a bunch of miles, which they then give you on the credit card. That was almost $2 billion of revenue to Delta last year. They also get fees for like the Delta Club of $1 billion too. They also get baggage fees of almost $1 billion last year, right? And then just other things. They actually own their own oil refinery, and they actually make some money on refining their own oil and jet fuel. So that's the other revenue. So because they split it out, so basically the dollars, the ticket revenue, everything else is the other stuff. Basically, that's what is challenging our model. We go back to our model of why this is $1.05. Second thing the accountants do to muck us up is they don't break out cost of goods sold and SG&A. They lump it together. So the SG&A line is actually picking up both cost of goods sold and SG&A together. Okay, typically you would see this in gross margin, but that's not the way they're reporting the gross margin. The gross margin is being screwed up because of the way they're reporting the other revenue. Yes?
Isn't that typical with a lot of airline companies? Like I also noticed that with Southwest Airlines that they had 0 COGS, but then they're like...
You're going to see the exact same thing for airlines. So some industries, some defense and aerospace do the same thing where they just won't break out COGS, they won't break out SG&A. They'll just lump them together. Well, that's when you guys go work for the accounting firms, figure that out with them. But in all seriousness, and I say this because it's a real complaint, because you're supposed to be standardizing across industries, but you'll quickly realize that not everything is standard. And so we have to kind of take the data that the accountants give us, and unfortunately, that makes this a little bit harder to analyze. However, the trend is still here, which is SG&As went from 91 to to 85.2, and the big drop was between 14 and 15 when it went from 94.5 to 80.8. So really, the story of Delta is the story of the big jump in operating margin between 14 and 15. By the way, the productivity, it got better on working capital. They went from negative 16 to negative 25. PP&E went from 57.9 to 54.3, and then up to 64. So it looks like they've been increasing their PP&E, and they're not doing a lot of acquisitions. So really, it was two things. The acquisition of planes hurt them, but not as much as the SG&A helped them. Now, this wasn't part of your assignment, but why do you think the operating margin jumped so much? What changed about their cost between 14 and 15? Decrease of oil prices. If we went back to Bloomberg and we just typed in price of oil, no, it's not that one. Price of oil. And we were to just graph it over 5 years, you can see that in 14, when oil went from 100 down to 40s and then eventually down to 20s, that was a big help for the airline industry. Okay, and you're going to see when you did Southwest, almost the exact same trend. Okay, so again, I'm mixing metaphors here. So let's go back to the valuation of Delta. That would have been the ROIC tree of Delta. Okay, so what's going on with the valuation? Why are we getting a crazy G? Okay, so I'm going to give you my surmise. This happens every now and then. I didn't expect it would happen here. We kind of stumbled across it, but it's a great learning lesson. So what does our model do? Our model for Delta Airlines, of which we have 19 analysts that are all buys, no holds, no sells, put in this EEO forecast. Based on this EEO forecast to do a DCF, we get a G that's like negative 10% given the current stock price. That doesn't make logical sense. So, what could put pressure on Delta's stock price today? What might the analysts or investors fear could happen? Increase in oil prices. And after last week, what could they also fear?
Tax rate hikes.
Not just tax rate hikes, trade wars. Because China already said last week, we'll take your tariffs and we'll up them with our tariffs. And how soon between China and the EU, which is Delta makes a lot of their money internationally, does airfares start getting put into this tariff global trade war mix? I'm not saying it's going to happen, but the fear factor is there, right? But more of the fear factor is what happens to oil prices. Because if oil prices go, today they're 65, if they go to 80 or 90, is that good or bad for Delta?
Bad.
It's really bad for Delta, okay? So here's what I think is actually happening. And I've seen it happen before, and I think this is what's happening here, which is basically the analysts have a lot of uncertainty about their earnings estimates. So too do the institutions. So what they do is they just make an arbitrary cut to the share price that basically doesn't reflect the actual cash flow forecasts of the EEO. Because that's what we're seeing is actually happening here. Because based on the EEO, which is a very optimistic share price, at any reasonable G, they should have a much higher share price. But they don't. So I think what the analysts are saying is, we're not going to revise our forecast down, but what the institutions are saying is, we're just going to revise the stock price down. And we have a discontinuity between what the analysts are saying and what the investors are pricing. And I think there's a fear factor in the marketplace. Now, if this is the University of Chicago, they'd be talking about now's where the piranhas come in and there's going to be an adjustment. Because one of two things is going to happen. Either the analysts are going to start dropping their forecasts and they're going to be a little bit more bearish because that's what the share price represents, or the bearish sentiment, that arbitrary cut is going to go away and the share price is going to adjust back to those cash flows. But right now we have a disconnect, and the academic formulas are showing that between what they're saying the cash flow should be and the price of the stock. And the reason I say that is because of the G. You don't get a negative 10 to 12% G when everybody talks about great times to come. And I'm just saying, it's not that the formulas don't say this is what the G would have to be. So I go back to, I think what's happening is the analysts are saying, fear factor of higher prices and potential trade war. So what I'm going to do is I'm just going to discount the airlines. But I don't have a definitive view, and I think my best scenario are still these earnings estimates based on the rosy scenario of the airline industry. And so we see a discontinuity. And this doesn't happen very often. I think we just stumbled upon it. We don't have time today. It'd be interesting to see if Southwest is in the same boat, if American is in the same boat. Because I don't know if this is a Delta issue. It might be an industry issue. But that goes back to just the uncertainty that we're seeing in the marketplace. And this is what I mean by sometimes when you do the math, when you plug and chug, is going to come back to you and give you something that makes no logical sense, right? And we can't do this exercise on no logical sense. Because if you do a negative 10% G or a negative 12% G, then the next thing you know, you're just going to get craziness with your share price. And in order to justify it, you're just going to do things that are completely unrealistic. So what I'm saying is this is when it gets harder, but you have to sometimes say, you know what, this is an exception. It's not that the formulas are breaking down. It's just people are actually not behaving with the data that they're actually representing. Okay, they're behaving, you can call it irrationally or rationally, but either way, the formulas work. The problem is the math that they're using is coming up with a different price than what we're actually seeing Delta trading at. And that discontinuity is what we've stumbled across here in class today. If I had to guess, even though, this would be my opinion, if we were to do a bull and a bear, we don't have time to fully cover it today, I would actually say that I believe Delta is near the high end of the range, that its current stock price is actually close to the bull scenario. And I think there's a lot more downside to Delta than upside. And this is what is a little bit ironic. I think very quickly you could see those 19 buys quickly go down if they adjust their earnings forecast, if they get more certainty on one of those catalysts for higher oil prices or bad things in the trade war, particularly higher oil prices. So I think that that's actually what's holding Delta back. If that sentiment goes away, I think the stock price could pop. Okay, but right now, I think to some degree, the bull scenario has been placed in to the analyst estimates. It hasn't been placed into the actual stock price. But that makes me nervous because what the analysts and investors are disagreeing is the investors are saying, I don't believe the rosy scenario that you put out there, and I'm not paying for it, right? So that's the point. The people that are actually buying the stock are not the people that are the sell-siders who are guessing these forecasts, and the investors don't believe it. Otherwise, they would price Delta higher. So here we see a little bit of a disconnect between the buy and the sell side. And right now, the buy side is being a little bit more tepid on their views. Hence, why I think that either you got to change the buy side sentiment or you got to change the sell side sentiment. They got to meet somewhere in the middle. And that's what we've uncovered. We could talk about this in terms of our buy, sell, hold, but regardless, what I wanted to illustrate is I don't want you to be a robot, meaning I want you to plug and I want you to solve, but sometimes you're going to solve and you're going to get crazy data, and this is crazy data. You don't get G's in this range. That's why you got to put common sense on. That's why I wanted you to look through the Investor Day report, because if you look through the Investor Day report, they don't say that there's a hurricane coming. Okay, they actually talk about blue skies ahead. And that is probably why the analysts are so bullish, and that's why they put in the numbers. But not trading that way if you actually ran their numbers through our formulas. And that's where we've noticed the disconnect. And that's why we have to figure out what this really means when we do our valuation. That's why I call it the art of valuation, not the science, because the science is breaking down a little bit. And it gets messy in the real world, and that's what makes it interesting. So let's go back. Let's do our CFI. I think this also infers one of the other challenges with Delta. So you do your CFI. Free cash flow, $25 billion. 2013 was an outlier because of the big tax refund. So really, I would focus more on 14 through 17. Went to 4.3 billion, down to 4, to 2.8, to 2.8. Why? Because the reinvestment rate went from negative 37 to 36 to 56 to 53. So clearly, the last couple of years, they've been spending a lot more on reinvestment, particularly capital expenditures, which means they're buying planes. If you go to the Investor Day report, what did they say they're buying? What are they buying? What kind of planes? Did you guys look through the Investor Day report?
Can you repeat the question one more time?
What did they say they're buying, types of planes they're buying in the Investor Day report? What did they say? They're retiring their 747s. They're retiring their MD-88s.
Or they're getting the 787 Dreamliner.
No. They're buying the Airbus A350 to replace the 747s, and they're buying the 737 MAXs and Airbus 321s to replace the MD-88s. And they said over the last couple of years, those planes actually have more seats, 20% more fuel efficiency, which actually is giving them lower cost to operate, and more ability to have premium seating, so that they now have 4 classes of pricing, and they're actually getting better yield on the planes because they can actually price them higher for better seats with premium experience. That is what the benefit of the plane purchase. What I'm saying is if you link it back to the CFI, this is the CapEx that they spent that led to that. And they said they're not done. So here's the point. That's the reason for the increase in reinvestment. That's why their free cash flow dropped. In terms of the non-operating cash flows, basically there's a 1-year outlier, 2013, which distorted the non-operating cash flows by almost all of this. So really, the difference between the free cash flow and the CFI was the 2014 change in tax policy at Delta Airlines, creating negative $7 billion in non-operating cash flow. So with the $19 billion, what'd they do? Spent $1.2 billion on interest. They issued about $3.9 billion more debt. They also funded a lot of their retirement liabilities of about $6 billion. They've been increasing their dividend. Now it's about $2 billion in dividends, but it's increased every year. And they've been increasing their share repurchase, although it did drop a little bit in 2018. They bought back almost $8 billion worth of stock. And the 1 year they did increase their debt was last year by $1.5 billion. Looks like primarily to either keep up the share repurchase or probably more likely to help fund the retirement-related liabilities. So that's what they were doing with the CFI. If we jump over here to Southwest, what do we notice on their CFI? Well, first of all, their investment rate also went up between 14, 15, and 16 and 17. Again, Southwest buying a lot of planes the last couple of years. So this seems to trigger an industry trend. By the way, with Southwest $6.6 billion of free cash flow, which their best year was 2017, because they also did something with their taxes that benefited them that year, if you remember. They ended up with $5 billion of CFI. They basically increased their excess cash a couple $100 million. So really, most of the free cash flow was distributed. $300 million to interest expense. They issued new debt the last 3 years, $1.3 billion total overall. They actually increased their retirement-related liabilities by about $127 million. So for them, it was $6 billion a share repurchase and about $900 million of preferred stock. Of common stock dividends. If I look at their ROIC tree, what I see is that their ROIC end of year went from 7.2 to 24.5. Although, as I said, cash tax rate was affected in 2017, so they did kind of what Delta did last year, that Delta did in 2013. So generally their tax rate's been in the mid-30s before. Pre-tax ROIC went from 11 to 22.8, again peaking in 15. So this 14 to 15 jump is the same jump Delta had in its operating margin, going from 12 to 20.8 and then down to 16.6. But basically this was oil prices. Very tied to oil prices at Southwest as well. Same issue with the crazy gross margins. Remember, they have the Southwest Visa card, plus they don't do bag fees, but they do other fees. SG&A, again, lumping them together because the accountants, big benefit when their operating costs between 14 and 15 went from 88 to 79. And working capital, just like Delta, got more negative. That benefited them, but they bought more planes. So it's almost a mirror image of the direction of Delta, with the one exception of the weird tax thing. But It also is the timing. So I think we can see a couple of industry trends here. Trend number one, lowering oil prices really benefited this industry, not just Delta. Trend number two, they all started buying planes when they started making a lot of money. Trend number three, I think investors are worried about that because suddenly all these new planes show up. Now we have a glut of supply. Glut of supply, potential fare war. So that's the thing. What we have to do is we have to take the planes and replace the planes. But if we're taking planes, we're actually putting new planes in. So if you remember about a month ago in class, I made a reference to where United had their stock hammered because they bought a bunch of planes in response to Southwest buying planes because they were losing market share in Texas and the Southeast. And Southwest had been adding capacity. So United decided they needed to add capacity to fight Southwest add capacity. Then roll that on to Delta. Delta adds a bunch of new planes too. The next thing you know, we got a bunch of bunch of supply, not as much demand. What do? I worry about the stock price. I don't hear Delta say that affects me. My EEO forecast at the sell side is still very positive, but I, the investor, arbitrarily discount the industry because I worry about a fare war, I worry about oil prices, and I worry about a trade war. And I think that is what's impacting the stock prices and causing the disconnect between the two. That's what I got out of this. Right? Now, you're not going to have to do all of this necessarily for the midterm exam. You're just going to have to do a walk of these two companies. But nonetheless, that's the walk that we need to do. And this is the interesting thing that we've kind of stumbled upon by picking up the airline industry this week. Questions about any of that? All right, so reminder. Reminder number one, homework 6 is now going to be an in-class assignment next week. You don't have to do anything after the midterm. Midterm exam 2, you will take during your registered class time on Wednesday. Okay, you don't have to be here, but it's an individual exam. It is open book, but it's not collaboration. It's not a group exam. You do it individually. 5 essay questions. 2 of the questions give you a CFI to analyze, give you an ROIC tree. Make sure you refer to specific numbers when we do that. Okay? And then otherwise, our next physical class will be a lecture 1 week from today. Okay? Everybody, have a good rest of your week. We're done.